Welcome back to KTM Investing. One of our subscribers requested more information on how to trade options, so today we will be discussing options trading and how to make a profit from the stocks you already own without selling your shares. What if you could make money in the stock market even if your favorite EV stock like Tesla or NIO doesn't skyrocket? Most people think you only profit when stocks go up, but that's not the whole story. The usual mantra is, you buy low and you sell high, and that is how you make a profit. That's the classic advice. But the big firms on Wall Street and seasoned investors have other ways of making their stocks work for them to earn additional income. You might be thinking, but what if the stock drops or just goes nowhere? And usually, that would mean you're stuck or losing money. But here's the game changer we are about to show you: options trading. Options sound complicated, but with a little know-how, and after watching this video, even beginners can use them, especially with volatile EV stocks like NIO and Tesla. Their price swings create unique opportunities if you use the right strategies. In this video, I'll break down options trading in simple terms, with no jargon and no complex terms or theories. We'll cover how to make money if a stock goes up, down, or even stays flat. Think of this as your beginner's playbook for unlocking new ways to profit from the stock market. Using EV stocks as our examples, we'll talk about what options are the basic types and walk through practical strategies that you can employ to create additional revenue. Ready to add more tools to your financial toolkit? Let's dive in. So, what's an option? An option is a contract that gives you the right, but not the obligation, to buy or sell 100 shares of a stock at a set price by a certain date. The set price is called the strike price, and the date is called the expiration. The cost you pay to purchase this option is called the premium. There are two main types of options: call options and put options. You buy a call option if you think the stock will go up, with each call option representing 100 actual shares. For example, if Tesla is at $180, you could buy a call option to buy the stock at $185. If Tesla jumps to $200, then your call option is now valuable, and you are now what they call in the money, as the stock is worth $15 more than your strike price. If you think the value of the stock will go down, then you would purchase put options. It's like insurance or hedging your bets. For example, if NIO stock is at $5 and you buy a put option at $4.50, then you're protected if the stock price drops to $3 per share, because you bought the option to sell your shares at $4.50 per share. So even though the market price says $3 per share, you are still able to sell at $4.50 because of your put option. Each contract covers 100 shares, so a $1 premium means $100 per contract. Calls mean you are betting that the stock will go up. Puts means you are betting that the stock will go down. The key terms to remember are the strike price, the expiration, and the premium. These are your building blocks to understanding how to trade options and make some quick cash while still holding on to your shares. If you can master these basics, then you're ready for more advanced strategies. Now let's see how these work in some real examples. If you already own shares of a stock, for example NIO, then selling covered calls is a smart way to earn extra income. It's like collecting rent on your stocks. Covered means you own at least 100 shares for every call you sell, so you're protected if the buyer exercises the right to purchase the stock. Let's say you own 100 shares of NIO at $5 per share, and you think it'll stay flat or rise a little, so you sell a call option with a $6 strike price that is expiring in 30 days. You will then see how much traders are willing to pay in the bid-ask section of your transaction, and you will also see in the limit price section the bid price, the midpoint price, and the asking price. You can either sell the call option at the bid price to ensure that the call option is purchased, or select the midpoint to get more for your option. You can also choose to go for the asking price, but it is less likely that the order will be filled, so the midpoint is probably your best chance of getting a good price and getting the order executed. In this scenario, we will select that you sold the option at a midpoint of 50 cents. This means you instantly collect a 50 cents premium per share for the 100 shares that you sold the option for, and you collect the premium of $50. If NIO stays below $6, then the call option expires worthless to the person who purchased it, and you keep the $50 profit. However, if NIO rises above $6 strike price, and the buyer exercises the option, then you would have to sell your shares at $6 per share. When you sell your shares at $6, then you would have still made the $1 per share difference from your $5 purchase price at which you owned the stock, plus the $50 you made from selling the option. This would result in a total profit of $150. The $1 per share difference in the stock price and the $50 you made from selling the call option. The downside of options trading is you can miss out on the potential upside. For example, if NIO rockets to $7 per share, you are still obligated to sell the 100 shares to the trader who purchased the option from you. Even though you made $150 from the transaction, you no longer own the shares, and the stock price may keep climbing. This is the risk of selling options. You can potentially miss out on a tremendous jump in the stock price. We suggest not selling options on stocks you think will increase 10% or more before the expiration date. You must also be willing to part with your shares if necessary. So if you are not okay with losing the shares and receiving your $150 profit while missing out on the upside in the example we just gave, then I would stay away from utilizing this strategy. However, if you are okay with making the $150 profit and missing the potential upside, then this strategy lets you generate steady income month after month if you implement it properly. It's a favorite for long-term investors who want to boost returns. Covered calls are simple, lower risk, and perfect for stocks you already own. Just remember, your upside is capped, but you get paid for it. Repeat as often as you like. That's the power of covered calls. If you're worried about a sudden drop, buying put options is like buying insurance for your shares to protect yourself from the downside. Suppose you own 100 shares of NIO at $5 each, but you're nervous about upcoming news. You can buy a put with a $4.50 strike expiring in 30 days for a 20 cents premium, $20 total. And if NIO drops to $3, your shares will be worth $300 at that price, but your put lets you sell at $4.50. So you get $450 instead. Your loss is just $70, $50 on shares plus $20 you paid to purchase the put, instead of losing $200. If NIO stays above $4.50, your put expires worthless, and you lose the $20 premium, but your shares are safe. It's a small price for peace of mind. Puts are a smart way to limit losses in volatile markets. Use them when you want to protect gains or sleep better at night. Think of it as a safety net for your portfolio. Sometimes the cost of protection is worth every penny. That's how puts can save your bets on volatile stocks. By the way, if you are finding this video informative and want to support our channel, go ahead and smash that subscribe button so we can keep bringing you more content. It's free to subscribe and it really helps out the channel with the YouTube algorithm. Now back to the video. Expecting a big move in a stock but not sure which way? Then you should try a straddle. A straddle means buying a call and a put at the same strike price and expiration. You're betting on volatility, not direction. Example, if Tesla is at $180 and their earnings report is coming out soon, then you would buy a $180 call option and a $180 put option, both expiring at the same time. Suppose the call costs $5 and the put $4.50, total $9.50 per share, or $950 for both contracts. For you to make a profit, Tesla must move more than $9.50 either up or down. If Tesla jumps to $195, a $15 swing to the upside, then you net $550 because of the call option. And if it drops to $165, which is a $15 swing to the downside, you make the same $550 profit because of your put option. However, if Tesla stays at or near $180, then you lose the $950 premium you paid to straddle. Straddles are risky, but can pay off big when you expect fireworks. Use them for earnings, news, or any event that could shake up the stock. Ready to try options? Here's how to place your first trade. First, open a brokerage account approved for options trading. Fidelity and Robinhood are a good place to start. Choose your stock, let's say NIO. Decide your strategy. If you're bullish, then buy a call. And if you're bearish, then buy a put. Or if you are simply looking for additional income, then sell a covered call. To get started, go to the options chain for whatever stock you have at least 100 shares in, and then pick the type of option, either call or put, and then select the expiration date, the quantity, and the strike price. The term out of the money is the price not yet reached. Options are cheaper, but riskier. The term in the money is the current price or lower than the current price. and the options cost more, but are safer. Click the option you want, call or put, then select Buy to open, and enter the number of contracts. One contract equals 100 shares. Use a limit order to control your price. Double-check all details, cost and commissions, then confirm your trade. And that's it. You're in the options game. Let's recap. Buy calls if you're bullish, puts if you're bearish. Sell covered calls for extra income if you own 100+ shares. Buy puts as insurance to protect your portfolio. Use straddles when you expect big moves but don't know the direction. Each strategy has its own risks and rewards. Choose what fits your goals. Start with paper trading to practice risk-free. Most brokerages offer virtual accounts to test your skills. Keep learning and exploring. Options are powerful, but knowledge is key. Don't be afraid to ask questions or seek help. The stock market is exciting and options can help you make the most of it. Don't forget to like and subscribe to KTM Investing for more market insights and analysis. Thank you for watching and we will see you in the next video.